Well, here with more reaction to the Fed's 25 basis point hike is Dennis Lockhart, former Atlanta Fed president. Good to talk to you today. As Seana said, we're 10 minutes out from the Fed chair taking the podium there. A very tricky line he has to toe here between sort of, the expectation here of where the Fed stands right now, but also messaging to the market that September is still in play so that there's not sort of that complacency, the expectation of now a cut down the line. How do you think he does that in this press conference?
I think he'll be non-committal about September or November in terms of a rate hike, but we'll certainly acknowledge that it's possible. He won't take any meeting off the table. I don't think he's going to suggest that the skip that we had in June and then the hike we've had today is somehow a pattern that they're locked into. I don't think that's wise. And he'll emphasize that there's quite a bit of data to come in between now and September, and the committee will be looking carefully at that data and deciding what the next step is.
Dennis, we certainly have heard from a number of Fed officials, Fed members, a number of them arguing or urging for more rate hikes, saying that we're far from really the point where we should be declaring victory on inflation. When you take a look at the recent prints that we have gotten, what do you think that last mile, that final battle is going to look like when the Fed is trying to get that inflation rate down to its 2% target?
Well, I think using the term last mile is a good device because it's going to be, in my opinion, much more difficult to get from a run rate of 3% to a run rate of 2% on core measures that are not just headline and not reflecting volatility from month to month. And that could take a while. And therefore, I think observers should be patient because I don't think the objective is going to be achieved anytime in the near term. It is probably a 2024 development and maybe even later than that. So I'm in the hold for longer camp.
In terms of, where that 2% target, there is a growing debate right now, not inside the Fed, maybe we haven't heard, at least publicly, about whether, in fact, that 2% target, what that target should be at 2%. Nobody expects the Fed, other central banks to change the rules of the game in the middle of this tightening cycle. But I'm curious how you view that. Should, number one, the target be at 2%? And if not, is the Fed's credibility that much more important? In other words, is it important to get to that 2% to hold the Fed to its word, even if that target is not necessarily where we need to be?
It's a really, really tough question, it seems to me. Much has been invested in 2%. 2%, I think, is the public's notion of what the Fed's objective is. That's what inflation expectations should gravitate to if you believe the Fed is effective in doing its job. It's an international standard, and when we in the committee made the decision to become an inflation targeting central bank, the international standard was part of the consideration. So there's just simply a lot behind choosing 2%. The big question in my mind is whether the nature of this post-COVID economy and the nature that will last for some period of time, maybe decades even, is simply different. And a slightly higher inflation target is more realistic given structural elements in the economy. That's a big cosmic question, and that's a seminar in and of itself, and I'm sure there'd be a lot of opinions on that. I just don't see them coming off 2%, quite frankly.
Well, Dennis, if they don't come off 2%, they remain committed to that 2% target. We've already seen this growing split, it seems like, inside the Fed right now as to what exactly the central bank should be doing or how they should be looking at some of the improvement that we have seen when it comes to inflation. Going back to that credibility part that you just briefly answered there, the fact that we do see this growing split, does that at all put at risk the Fed's credibility, given the fact that Powell has to figure out how to walk this very, very tight rope in his messaging and make sure that the market doesn't get too excited about what the Fed's doing, but also maintaining that balance with some of the risks that inflation still poses to the economy.
Well, I think, yes, Powell has, as he always has, a very difficult messaging challenge, both near term and over time. There has been some, I take it, serious discussion of communicating the inflation target as more of a range than a point. And I do think that's worthy of consideration. So what you may see in order to deal with this divide within the committee is a consensus building around the idea that the inflation target is between 1.75 and 2.5% or something like that. And when they get into that zone, they will feel that they have met their statutory mandate. So there are probably some messaging and communications things they can do that reduce any tension within the committee on this question, and at the same time achieve a little bit more realistic position given the structure of the economy and the way the economy is evolving.
Looking ahead here, sort of the question that we've been asking over and over is after all this talk of a recession, when does that recession, if it in fact is coming, when does that materialize? How has your thinking on that evolved over the last, at least the first half of the year, as you look at the economic data points?
Well, if I go back further than just the first half of this year, my mantra was the longer inflation persists, the more likely we're going to see it end in a recession. And I've been proven wrong in that respect. Inflation has persisted, and I don't think a recession is imminent in any respect. It still may result in a recession, although I would put my odds on mild and short-lived. But I have been really quite amazed by the resilience of this economy, the strength of the labor market, and that seems to continue. We have a virtuous cycle of employment, consumer demand, and therefore economic growth.
Dennis, what do you think the Fed needs to see in order for the Fed to be comfortable with holding rates steady, and also how they're thinking about the timeline of this higher for longer environment?
Well, remember, one of the debatable questions that the policymakers have talked about is whether they're going to wait for outcomes or whether they're going to make their decisions based on forecasts or outlooks. If the outlook is for achieving something close to the 2% target, they could pause, but there probably is going to be a contingent in the committee that would want to wait for absolute achievement, meaning proof that 2% has been achieved. And I think that's going to be one of the questions for later this year and into 2024 is on what basis will they pause? But what they would be looking for is convincing evidence. In my mind, convincing evidence is a series of largely similar reports that show, very definite move in the direction of the target, with few anomalies that would somehow question the direction of inflation.
All right, Dennis Lockhart, thanks so much for your time. Really appreciate your insight.
Thank you.